Pay close attention to what I'm about to share. The global silver pricing system has just experienced a fundamental structural collapse. As you watch this on Saturday, February 14th, 2026, we are witnessing the most extreme and sustained price divergence in the entire history of precious metals trading. While paper traders on Wall Street are trying to persuade you that silver is valued at $84 per ounce, the physical market in the East has already decisively crossed into triple-digit territory. Yesterday, the Shenzhen Shuibei gold market, one of the world's largest physical precious metals trading hubs, recorded spot physical transactions at $136.80 per ounce. That represents a 40% gap between New York and Shanghai. Under normal market conditions, a spread like this is mathematically unsustainable. It shouldn't exist. Arbitrageurs, the sophisticated traders who profit by exploiting price differences between markets, should be snapping up every available ounce in New York and shipping it to China to capture a roughly $50 per ounce profit. That's essentially risk-free money. It's the kind of opportunity that gets eliminated within hours in any properly functioning market. But they can't close it. The mechanism is broken. The arbitrage process that has kept global commodity prices aligned for decades has completely collapsed. The separation between paper promises and physical reality is now total and irreversible. In this Emergency Monday Market Alert, we're going to dissect exactly why the arbitrage trade has failed. We're going to analyze how the 98.1 million ounce collapse at the COMEX on February 11th has triggered what I'm calling a physical blackout. And we're going to explain why you have only until 6 p.m. Eastern Standard Time tomorrow to position yourself before the double trigger of Tuesday morning strikes the system like a financial shockwave. This is Silver Media. I'm John, and the data we're about to present will permanently alter how you view this market. Before we get into the vault figures and technical analysis, I have a request. If you value original financial research, if you want to support the fight against AI-generated content farms that are deliberately misleading the stacking community, subscribe to this channel right now. Comment on Alert AG below this video. By posting those 2 words, you're telling the algorithm that this is a primary source of actionable intelligence. You're helping push this information to other stackers who urgently need to see it before the Sunday open. Do it now. Then let's explore why this impossible gap exists and what it means for your financial future. Why the arbitrage mechanism has failed. In a properly functioning market, the kind described in economics textbooks, price discrepancies are resolved automatically through arbitrage. The process is straightforward and elegant. If silver trades at $84 in the West and $130 in the East, traders purchase cheaply in New York and sell at a premium in Shanghai. They capture the difference. Competition among arbitrageurs rapidly eliminates the gap, and prices converge within hours. Simple in theory, except it's not happening. As of February 2026, the silver market no longer operates normally by any conventional standard. The mechanisms that should synchronize global prices have entirely broken down. David Morgan, publisher of the Morgan Report, and one of the most widely respected analysts in the precious metals space, recently issued a warning that perfectly encapsulates the current situation. He stated that the physical market has seized control over the paper price, that physical reality is now overriding paper fiction. Let me walk through precisely why traders are unable to close this $50 gap despite the enormous profit potential it represents. The first factor is China's export restrictions. Beginning January 1st, 2026, China, the world's dominant center for silver refining and processing, enacted strict export controls on refined precious metals. They are preventing the metal from leaving their borders. At the same time, they've established regulatory and tariff barriers that make it commercially impractical to bring Western metal into China through standard import channels. The pathway is blocked in both directions. The second factor involves refining bottlenecks. Most silver produced today isn't mined as a primary commodity. It's a byproduct of copper, lead, and zinc mining operations. Because mining output is fundamentally rigid, you can't simply increase production on demand. There's no mechanism to rapidly boost supply to address the 164 million ounce annual supply shortfall that has persisted for 5 consecutive years. The metal simply doesn't exist in adequate quantities. The third factor is the spike in lease rates. Silver lease rates have reached an unprecedented 8%. In plain terms, borrowing physical silver has become so costly that arbitrageurs can't afford to finance the time needed to transport bullion across borders. The carrying cost exceeds the potential return. Even a $50 spread becomes unprofitable when you're paying 8% annually to borrow the metal required for the trade. Here's the core structural difference driving this divergence. The Shanghai Gold Exchange operates on a physical first model with next-day delivery. When you purchase silver on the SGE, you receive actual metal within 1 business day. The price reflects what buyers are willing to pay for real silver they can physically possess. The COMEX operates on an entirely different basis, a digital promise system. The current ratio on the COMEX stands at roughly 356 paper ounces for every 1 physical ounce actually residing in the vault. When you buy silver on the COMEX, you're purchasing a commitment that may or may not be supported by actual metal. When the East insists on bars and the West only offers paper, prices must diverge. They're pricing two fundamentally different things. Shanghai is currently revealing the true price, what physical silver genuinely costs in the world's largest market dealing in actual metal. New York is displaying a fiction, a number representing paper commitments detached from physical reality. The COMEX vault crisis. Now let's examine the hard data from what just occurred in the United States. While most investors were fixated on the S&P 500 and ignoring the precious metals sector entirely, on February 11, 2026, just 3 days ago, official COMEX depository reports confirmed a massive withdrawal that should be front-page news on every financial outlet in America. The registered silver category, the metal actually available to fulfill futures contracts, the only silver that legally supports the paper commitments made on the exchange, crashed through the 100 million ounce psychological threshold. Total registered inventory now stands at precisely 98,138,050 ounces. That figure deserves emphasis. For the first time this decade, the COMEX has fewer than 100 million ounces available to settle contracts. The safety cushion is gone. The buffer has disappeared. But the single-day drain on February 11th is even more disturbing than the absolute level. In one trading session, we witnessed a net outflow from the entire COMEX system of 4.7 million ounces. The registered category alone fell by 3.2 million ounces. Additional metal was pulled from the eligible category entirely, physically removed from the vault system and shipped to undisclosed destinations. Consider that pace for a moment. If withdrawals continue at this rate, and there's no sign the drain is decelerating, the COMEX registered vaults will reach zero in fewer than 21 days, 3 weeks. That's all the remaining runway at current depletion speeds, the March delivery trap. Now let's connect this to the approaching March delivery situation. The March delivery contract is closing in on the calendar. March has historically been the heaviest delivery month of the year for silver futures. As of this weekend, over 366 million ounces of open interest stand for March delivery. The COMEX has 98 million ounces to fulfill those commitments. The math is devastating. If just 27% of those contract holders demand their physical bars in March, if barely more than 1 in 4 traders says, "I want actual metal, not a cash settlement," the COMEX defaults. The vault hits zero. There is no metal left to deliver. This is precisely why the CME Group has raised silver margin requirements 7 consecutive times over the past month. Margins now stand at 18%, an exceptionally elevated level that makes it prohibitively expensive for retail traders to maintain positions. They are aggressively trying to compel you to liquidate your paper contracts. They need you to close your position before you realize you can stand for delivery, because they know with absolute mathematical certainty that they don't have the metal to provide if you actually demand it. Every margin increase is a defensive action protecting the banks, not the investors. They're stalling for time, hoping the price falls enough to shake out sufficient contract holders so that the remaining delivery requests can be covered. While the COMEX drains in New York, the Shanghai Futures Exchange is confronting a naked short crisis that makes the 2021 silver squeeze look insignificant by comparison. The scale of what's developing in Shanghai is without precedent. A single reclusive billionaire named Bian, operating through his firm Jonai Futures, has accumulated a 450-ton naked short position on the SHFE. Let's break down the mathematics of this looming default. Bian is short 30,000 contracts representing 450 metric tons of silver. That's his obligation. He is committed to delivering that quantity of metal to the counterparties who purchased his contracts. Meanwhile, the SHFE's total deliverable inventory has plummeted to just 318 metric tons. That represents an 88% decline from the 2021 peak, when the exchange held over 3,000 metric tons. The critical calculation: Bian is short 130 tons more silver than the entire exchange actually holds. He has sold metal that doesn't exist. He cannot possibly meet his obligations through normal market channels. Understanding Bian's reasoning is key to grasping how the situation developed. In 2024, Bian was bullish on copper. He built his fortune by riding commodity trends with leveraged precision. In 2026, he pivoted to betting on what he believed would be a coordinated paper reset, an intervention by central banks and bullion dealers to force the silver price back down to $50. He believed the banks could generate enough paper silver to overwhelm physical demand. He was mistaken. You cannot fabricate a 1,000-ounce silver bar. You cannot conjure physical metal from a trading terminal. And when the market demands actual delivery, when industrial users need the metal for solar panels and electronics, paper commitments become worthless. When Chinese markets reopen on Tuesday, February 17th, following the Lunar New Year holiday, BN will be facing 1.4 billion potential physical buyers emerging from the holiday break. He'll be confronting a refining hub that has just sealed its doors to exports. He'll be facing industrial consumers who absolutely must obtain metal to keep their production lines operational. This is a scenario ripe for a vertical price surge that could propel silver to $150 by April. And that isn't just my estimate. That figure appeared in a recently leaked Bank of America internal memo circulated among their institutional clients. The largest short position in SHFE history is about to become either the most devastating loss in exchange history or the catalyst for a complete exchange default. There is no scenario in which BN unwinds his position smoothly. Today is Saturday, February 14th. You have approximately 30 hours before markets open for the Sunday session. Let me outline exactly what to anticipate and how to position yourself. Expect what we call the Sunday smash. Tomorrow evening at 6 p.m. Eastern Standard Time, when futures markets reopen for the new trading week, expect the bullion banks to orchestrate a flash crash. They will deploy every instrument available. The Kevin Warsh-fed hawk narrative, coordinated selling across multiple exchanges, strategic placement of paper shorts to pound the paper price down toward the $70 to $74 support zone. Why would they do this? Because they need to activate your stop losses. They need to force you out of your positions through fear and automatic liquidation. They need to capture your physically backed contracts, the contracts representing claims on actual metal, so they can redirect that metal to institutional buyers who are standing for delivery in March. This is engineered wealth transfer. The banks will manufacture artificial panic to force retail traders to sell, then use those liquidated positions to fulfill delivery obligations to their institutional clients. Here's what I call the sold-out paradox, the proof that the paper price has become meaningless. If you see silver drop to $75 tomorrow night on your trading screen, pick up the phone and call your physical dealer. Call any dealer. Call several. I guarantee one of two things will be true. Either they'll be completely sold out, no inventory at any price, or they'll be charging a $15 to $25 premium above the paper spot price displayed on your screen. If the spot price reads $75, but every dealer is charging $95 or more for actual metal, which figure is the real price? The spot price on your screen has become officially irrelevant. It's a construct maintained for the benefit of paper traders. The true price of silver is what it actually costs to get a physical bar loaded onto a truck today. That number has disconnected from COMEX quotes and is gravitating toward Shanghai quotes. The 40% arbitrage gap we're observing is not a temporary irregularity that will self-correct. It's an indicator that the global pricing regime is fundamentally migrating from west to east. The center of gravity for precious metals price discovery is shifting from New York and London to Shanghai and Singapore. President Trump's Project Vault, the $12 billion strategic reserve initiative, is the definitive confirmation of this paradigm shift. The United States government now officially regards silver as a national security asset. They're stockpiling with urgency because they comprehend what most retail investors haven't yet realized. The era of affordable, readily available silver is drawing to a close. Here is your plan for navigating the next 72 hours and beyond. First, tune out the paper noise. Do not allow a 10% Sunday night decline engineered by bullion banks to dislodge you from your core physical holdings. They are manufacturing fear to transfer your wealth into institutional hands. Identify the manipulation for what it is and maintain your position. Second, execute the arbitrage purchase if opportunities present themselves. If you can find physical bars or 90% constitutional silver at anything below $95 per ounce, you're acquiring at a significant discount relative to the $136 Shanghai reality. That gap will close to the upside. You're being presented with a deeply asymmetric opportunity. Third, consider the refining angle for equity exposure. Focus on mining companies that control their own processing infrastructure, like First Majestic Silver or Hecla Mining. In a world of export restrictions and refining bottlenecks, the entity that owns the smelter holds the advantage. Vertical integration becomes the ultimate competitive edge when supply chains fracture. We are just 17 days from the March 1st notice day. The countdown to a potential COMEX default is real and accelerating. Every passing day of continued vault depletion pushes the system closer to a breaking point that cannot be concealed with paper solutions. If you found this investigative analysis valuable, if this data changed your understanding of the silver market, share this video with every stacker you know. Share it with friends and family who hold precious metals. Share it with anyone who deserves to understand what's truly unfolding before the Sunday open. Subscribe now if you haven't already. Comment Alert AG below to stand with our original research community and signal to the algorithm that this information matters. Tell me in the comments, are you buying this manufactured dip when it arrives tomorrow night? Or are you waiting to observe how the Shanghai reopening plays out on Tuesday? I want to hear your approach.